the sun, I'm rising up, I feel the love now, oh, it's in my vision. You know I ran around, and I got lost, but now I found it, well, I can't shake this feeling. Oh, it's gonna take me a little while, just to get my head around this moment. But I can see the sun, I'm rising up, I feel the love now, oh, it's in my vision. And it's telling me run, 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 and don't give up. And it's telling me run, 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 and don't give up.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and welcome to the daily NASDAQ stock update. We get a flurry of buttons going there and everything and get everything working right. But hey, thanks for joining me today. We have a lot of really good information that we're going to talk about today. We have two stocks that we're really going to focus on today. One's going to be Regeneron, which is in the news yesterday, and the other is going to be Qualcomm. You might not be able to recognize Qualcomm, but if you have one of these, if you have a smartphone, you're probably using Qualcomm. We'll talk about that in just a little bit, but let's get into Regeneron, because Regeneron is in the news because of the development that they have made in a coronavirus treatment. It's not a vaccine, it's actually a treatment. And it actually, you want to look at this from the standpoint of how is it going to affect the stock itself? How is it going to affect it today? And what's going to be the potential for the impact of development of coronavirus drugs going forward from that standpoint? And that's really what I want to get into as we talk about this particular stock and everything else. But I think it's really valuable if you understand a little bit more about what Regeneron does. They're just not in the market to make coronavirus drugs. They make a litany of different drugs that are very useful to society. And I have a short little presentation here. This is about a minute long. Just watch and let's see what we can figure out what goes on with Regeneron. Yeah, Regeneron does create a lot of different types of drugs. And I think that that's the point that I want to get to today is the new drug that they have developed, which is the REGN-COV2. That's the code name that they've given to it. Let's look at a couple of points here that I think that are very important to consider when we're looking at this particular drug. All right, let's look at this. This is really a drug that's just primarily for sick patients. It reduces the severity and the length of the coronavirus. It helps the body to actually develop an immune response to healing itself, really what the body should be doing naturally. But if it can't kick the virus itself, it helps the body. It actually, if the virus itself lasts 14 days, this drug will help shorten that down to 8 days or less from that standpoint. The other thing is the company is I'd say that there's 100% probability that this company is going to get approval from the FDA to produce this type of drug. The impact that the drug is going to have on the stock is going to be actually minimal, because really, if you look at what's going on with Regeneron, in a few moments, you're going to see the stupendous returns that they've had over the past year. It's overpriced just a little bit right now. After hours yesterday, we saw Regeneron bounce about 2% in after hours trading. But really, as the day went on, you saw today it ended down about 2.5. So it really lost the gains that it had. As far as like the long-term impact of this drug on this stock, it's going to be minimal, because you have to understand that this is not like some of the other drugs that Regeneron creates. They create one drug that is for an eye disease. It's for age-related macular degeneration. And that particular drug is going to last forever, because people are getting older, and there's going to be older people that are going to be looking for drugs that help them with their eyes. That's going to last forever. The coronavirus is not going to last forever. The impact on the company's profits is going to be minimal. And as vaccines are created, the use of REGN-COV2 is going to be less and less as time goes by. But let's actually see what's happened in this stock over the past year, because it's truly amazing. A year ago, it was selling for $227.40. Today, it ended at $559.78. That's an amazing $146.17% increase. Now, listen, you heard about the drug creation. Don't try to hop on this stock at the very end because you're hearing good news now. The time that you should have been in it was a year ago. If you buy this stock, it should be to help you diversify your portfolio. It should be so that you can take advantage of some of the other drugs that they create, not just this one drug. Look at the earnings over the past year, because what we do, look, there's three things that we look for in stocks. One is we look for earnings, competitiveness, and three is stability. So let's look at how the stock in itself has gone over the past years as far as profitability goes. The solid line is going to be actual earnings per share. The dotted line is going to be projected. And look, it's up, it's down. They have not been really very predictable as far as like making their earnings. Recently, yes, they've done well in earnings, but in past quarters, it's been all over the place. So the earnings are kind of sketchy from that standpoint. There is no dividend. And when I say that, you're going to see that that makes actually a big difference when we're looking at drug stocks. Let's compare Regeneron to other drug companies and see how it competes, like Amgen and Novartis and Roche. You know, as far as like size of a company, Regeneron is small when it compares itself to Amgen, Novartis, and Roche. But look at the big difference here when it comes to profitability in the long term for shareholders. All of these other drugs end up paying a dividend, and Regeneron pays no dividend from that standpoint. Yes, okay, if you follow a dancing cursor, you see the past year of what went on with the stock's price, and it's done extremely well. I don't deny that, but the point is that it's probably not going to continue forever. And if you're going to try to jump on this stock now because you think that you're going to get a hold of the return that's come from this drug that's being created, I think that you might be fooling yourself. Remember, though, the past performance of these stocks is not the guarantee of future results. And remember also, we look at the moat of a company. What's the moat? Here's what the moat is. If I can get it to work. Clicking things has not worked as well today. But the point is that the moat is that imaginary barrier that's in between the company and between their competition. And really, Regeneron has a narrow moat that's associated with it. The patented drugs that they have are the real profit drivers for this company. Eylea, Proliant, Curvaza, Dexaprint, all those different drugs. None of those are coronavirus drugs. These are all long-term drugs that this company has developed. And if you're going to invest in this company, invest in it for these drugs, not for the new drug that's coming out for the coronavirus. Now, let's look and see what other analysts are saying about Regeneron. This is information that I garner from Morningstar. Morningstar actually says that this company is really only fair valued at 500. Of course, today it closed at 559.78. But you want to look at it from the standpoint: how does Morningstar get that fair value? They get it by a multiple of earnings per share. They just don't pull it out of the air. Really, they're saying that it's about 12% overpriced right now. Not too bad. They call it a two-star company. Remember, the star ratings are for they're for fair value and overvalue and undervalue. They're not to tell you that it's like a 5-star restaurant or something like that. It's based on value. Let's look and see what the other analysts are saying about Regeneron. Out of 20 analysts that were polled, 10 of them are saying, hey, this is a really strong buy, and 10 of them are saying that it's a hold. So when you average it out, yes, it does come out to... Yep, it comes out to a moderate buy. Not a strong buy, but a moderate buy. Okay, now let's keep going on, because I think that also, remember, this is not my recommendation to buy this stock. This is a reporting of what analysts are saying. I got to tell you that. All right, hey, let's look at Qualcomm, because if you own a cell phone, you probably are a owner of Qualcomm. Now, really, hey, the interesting thing about every cell phone that's out there, every cell phone, they pay Qualcomm, I say it right, they pay Qualcomm a royalty. You paid Qualcomm a royalty. So when I talk about this stock, think about that when you think about how many people are actually supporting this particular stock. Let's really see what they do. 133.3 billion dollars in market capitalization. That's a big company. Let's look and see what they've done over the past year. They started a year ago at $74 a share, thereabout. They ended today at $117. That's 58.77%. Okay, look, I have to tell you, don't get accustomed to these huge rates of return. I know I talked about Regeneron that had triple digits in the past year, and I'm talking about Qualcomm. And you might be thinking, wow, all these great stocks, I have to own them. Don't buy it based on that, okay? We saw in the past quarter actually was up, and I want to tell you about that real quick. I wrote it down. The Dow Jones Industrials was up 7.6%. The S&P was up 8.5%, and the NASDAQ was up 11.8%. That's for the past quarter. That's a pretty good rebound. Not all stocks are getting double and triple digits from that standpoint. So don't get accustomed to that. Remember, the past performance is not going to be a guarantee of future results. But let me tell you, one of the best things about this stock is that it pays a dividend. Remember, if you're a retiree, there are 3 reasons why that you want to own stocks. Number 1 is going to be you want to own stocks for growth, because if you're going to be retired for 30 or 40 years, you want to have something that you can pull from later on down the road. Number 2 is going to be dividends. Of course, 3 is going to be diversification, but the whole idea is dividends can be a significant part of your retirement when you put it into stocks. If you look at the NASDAQ 100, about 60 of those stocks are dividend-paying stocks. Those are the largest companies in the country. Now, they're stocks. They're not guaranteed. Neither is going to be the dividends, but bonds right now are paying paltry rates of return, and they're probably not going to do anything. When we saw Jay Powell, the Federal Reserve Chairman, came out and said, hey, we're going to keep basically zero rates until at least 2023. You're not going to get any returns off of bonds. Okay, so let's get back into talking about the different stocks today, about Qualcomm. That's where we're moving to. The earnings on this are a big, big difference than what we saw on Regeneron. You could set your clock on the earnings from this company. And they've exceeded, back in, 2014, they were a little bit under. Almost every quarter, The solid line is over top of the dotted line. That means that almost every quarter they have exceeded what the expectations are for their earnings, and the forward-looking expectation is even higher. So yeah, that's really pretty good from that standpoint of a stock. Let's compare it to see how it competes with other companies. Let's look at Qualcomm compared to Intel and Globalstar and BlackBerry. If you follow the dancing cursor, you can see that Qualcomm has beat them hands down, but they're all kind of bunched together. If you go back right after the coronavirus, right about this time period, they were all suffering about the same. Qualcomm has come out ahead, and probably one of the biggest reasons why Qualcomm has come out ahead right now is because they've won some of the different litigation that's gone on from their licensing. The biggest thing that they make money off of right now is going to be licenses. Of course, yes, remember the past performance is no guaranteed future results. Now, let's talk about the moat again. I'm not going to play the video, but I'm going to tell you what the moat is. Remember, it's that imaginary barrier that's between the company and their competition. Qualcomm, in my opinion, has a wide moat. Morningstar is saying that's narrow moat. The narrow moat is based on the fact that there's some other companies out there that are possibly going to be able to compete and take their business. Qualcomm has patent licenses with every major smartphone OEM, that's original equipment manufacturer, every last one of them. They have a monopoly. They have a legal monopoly on their patents, not just in the United States. It holds up in South Korea. It holds up in China. All around the world, they have a patent. So yeah, they're in every single phone that's out there, just about every single phone. They have the biggest threat right now is, let's say, for example, Apple has come out and said that they're going to start developing all of their chips in-house. Yes, if that happens, if Samsung does the same thing, they're going to have a serious threat to their revenue stream. But as far as profitability goes right now, Apple is just saying they're going to do that. I'm not saying that Apple's wrong, that they can't, but I'm just saying that all the other manufacturers of phones out there have to be able to say, we're going to take all that business in-house. And they probably aren't going to do it. Not quickly, that is. But Qualcomm is also setting itself up so that it can take advantage of the development of 5G. They also are into developing chips for automotive and then the Internet of Things. You know what the Internet of Things is? It's your smartphone, that's your smart home, it's your navigation, all that kind of good stuff. All right, let's see what Morningstar says about the fair rating of this company. They're pegging it at $90. Remember, it's a multiple of earnings per share. It's overpriced by about 30% according to Morningstar. So they're giving it only 2 stars as far as that goes. So let's see what the other analysts are saying about this. The other analysts are basically putting their hands down and saying, hey, this is a strong buy. There's one of them that says that it's a moderate, and there's one that says that it is a hold. So when you average it out, you come out to this. It's a strong buy according to the analyst reviews. So I want to remind you that if you want to talk to somebody about your retirement plan, go to my website at richardsfinancialplanning.com. Go down to the schedule a call to learn more button, and you can find a time where I can get on the phone or we can have a Zoom conversation and talk about how the ideas that I've given you today about stocks can fit into your portfolio. I'm glad to do that. Just remember that everything that I'm telling you today is general education information. I don't know you, you don't know me, other than, hey, I'm on the internet. But I'm here to help you with your retirement. If you need help, just go to richardsfinancialplanning.com and you can find a time and we can get a chance to talk. If you had comments or questions, put them into the comment section. I even read those afterwards, and I'll answer you if you have a particular question, and we'll bring it up on the live stream tomorrow. So today's Wednesday, just the middle of the week, hump day. All right, so I have a disclosure coming up. Make sure that you read that, because that tells you the ands, ifs, or buts about everything that I said. I'll talk to you tomorrow. Have a great day.